Ladies and gentlemen, if I could just ask for your attention, please. Well, good morning, everyone. My name is... Oh, hold on, our screens have gone. There we go. I'm back. My name is Lexi Shaw. I'm managing partner at AC Mole. And it's my pleasure to welcome you all here this morning on behalf of Clarke Willmott and AC Mole for our autumn statement breakfast. And as with previous events, I know a number of you are joining us from the comfort of your living rooms or offices this morning, so a warm welcome to you as well. And thank you all for taking the time to join us this morning. I'd like to extend a big thank you to Amanda and Tom. We were saying this is the quickest I think we've ever turned around our update, obviously with the statement only being yesterday. I know they've spent a lot of time, a little bit of midnight oil burnt last night to get this all ready for you this morning. So I'm sure you'll join me in extending our thanks to them for getting us ready. And it does feel a little bit like Groundhog Day, I must be honest. I feel like I was here not that long ago. And we were talking about the fiscal statement as it was at that point. And there's been various dates scheduled and rescheduled since then for various updates. So we hope this is the last, it may be third time lucky, but fingers crossed this is the last one we'll have for this year at least. And I know last time when I spoke, I talked a little bit about crunching the numbers and the fact that as an accountant, I felt a little bit nervous that there seemed to be a little less maths done around some of the announcements that had been planned. And certainly this time around, I do take a little bit of comfort that it feels like that someone has looked a little bit more closely at the numbers and looked at the maths. We've had a very expensive few years and there's a bit of a gap there to be filled. So it looks like that's certainly been looked at much more closely this time, which as a numbers person gives me a little bit more confidence. And it's my pleasure, obviously, to introduce our two speakers this morning. We're joined by Amanda Gunter, tax partner at AC Mole, and Tom Chiffers, partner in the private client team at Clarke Willmott. And as with previous events, there will be the opportunity to ask all your burning questions of Amanda and Tom at the end. And if you're joining us online, again, there's the option to ask a question using the Ask a Question function. You just need to be logged in using your Google account to do that. So I think without any further ado, I will pass over to Amanda for the first of this morning's presentations. That one not quite working. You might need...
Thank you, Lexi. Oh, the technology works. Thank you. Well, like Lexi said, it has felt like Groundhog Day, but the announcements yesterday in the autumn statement were very different to what we heard only a couple of months ago with the mini budget. For us in tax, it has felt like a bit of a tax roller coaster. And I was talking to a few people this morning and said, actually, while I was doing my slides, there were moments where I was thinking, actually, I can't remember what the tax rate is after all the changes we've had. Now, it didn't surprise me when they stood up yesterday and announced that the priorities for the government started with stability. The good word is what I said after the last mini budget is that we weren't having was stability. So of the three priorities that the Chancellor announced yesterday, the top one was stability. It was then followed by growth and public services. Now, we may remember that in the mini budget, the focus was on growth. It wasn't on stability. And we then saw market turmoil after the announcements from the mini budget. They have changed their priorities now, so stability is at the top. We then have growth and then public services. So the backdrop of our autumn statement was, in many ways, inflation, which we've all heard about and we're all starting to feel. So inflation over the last few years. Now, last month, our inflation hit 11.1%. Inflation has gone up month on month, we've seen this year. And as you can see from the slide, in 2021, we saw inflation of 4%. Now, I can remember doing I think it might have been the autumn statement then in 2021, and I was saying that 4% inflation was worrying. The government's target for inflation is 2%. So you can see that if our average for the year is 9.1%, we are way above where the government's target is for inflation. Now, the Office for Budget Responsibilities report says that their forecast for next year is to drop to 7.4%. Now, they are anticipating that mid next year, so around June time, we should see some quite significant drops in inflation, which will help to bring down that average to 7.4%. We're still a long way off the target of 2%, and they haven't given any forecasts yet of when they think they will be achieving that. But the Bank of England and the OBR report both say they are expecting quite significant drops from mid next year. The Bank of England have a remit to actually try and control inflation, and as we've all seen, their methods over the last few months have been to increase interest rates. So along with inflation, we've also seen our interest rate increase, and our current rate is 3%. But the one thing you will see there, all of those numbers have changed in this year. We have had 7 increases in the Bank of England base rate in 10 months. It's quite a lot to manage over a short period of time. Now, when you think about it, actually 3% interest sounds quite shocking, but solely because of what we were used to. The Bank of England base rate has been very, very low for a long period of time. But I was talking to one of my colleagues the other day who used to be in banking, and they did quite a good exercise and had a look at the average interest rate over the last roughly 40 years. And it came out at 6%. So when you think of the average over the last 40 years, we're still a lot lower at 3%. Now, does that mean that we might see further increases in the interest rate? The Bank of England haven't ruled that out, and their target is to control inflation. Now, at the presentation I went to a couple of months ago, it wasn't ruled out, but you could see on their forecasts that where interest rates went up, once they were started to control inflation, then they would start to come down again. Whether they will start going down to the levels that we've seen historically, we will have to wait and see. So, some great news already, so let's continue in that vein. We're going to have a look at our growth situation. So, our growth predictions. Now, at the moment, for this current year, we are still expecting to see growth of 4.9%. But we have already had 1 full quarter of negative growth. And here in the UK, for it to be a formal recession, we need 2 quarters of negative growth. The OBR are predicting that our current quarter will show negative growth, and therefore we are at the start of a formal recession. The OBR report does also say that growth next year will be negative 1.4%. So our recession continues. Now, if you look into the numbers, the Bank of England and the OBR are predicting that the recession period will be roughly for a year. Now, for many of us sat in this room, we may think that seems quite fast. We will have to wait and see how that pans out. The OBR report at the moment does say, however, that as we move forward, we've got growth of 1.3%, 2.6% and 2.7%. Now, if anyone was around for the mini-budget when we were doing the presentation, you will be aware that the growth forecast the government were looking for is 2.5%. That was going to be their medium-term target of 2.5% growth. The OBR are then looking from 2025 that we would be having that level of growth, which would be slightly above the 2.5% target. That might be quite quick. We will have to wait and see. Let's move on. I don't want to make you feel too bad, but we're going to look at borrowing. Now, I don't think I've ever stood up in front of anyone and said that our borrowing is in a good position. So this year, how much are we going to borrow? 177 billion. Now, to explain borrowing, our borrowing is what we need each year to cover all of our outgoings. So our borrowing is over and above what we raise from our taxes. This year, 177 billion, and that's 7.1% of our gross domestic product. The forecasts show that with factoring in all of the tax policy changes that we see in the autumn statement. Next year, our borrowing will be 140 billion, and they are predicting it to drop in 27-28 to 69 billion. Now, you'll see that there is no point in there that they forecast where we get break-even or positive. There is always a borrowing situation, and they haven't taken it any further forward. But he did announce a new fiscal rule. Now, I'm going to have to read it because it's quite wordy. But our underlying debt must fall as a percentage of GDP by 5th year of a rolling 5-year period. Now, when I heard him say that, I thought, okay, what do you mean? So our underlying net debt to GDP in 2025-26 is going to be our peak year per the OBR. And we are going to be borrowing 97.6% of our gross domestic product at that point in time. The new fiscal rule means that they want that percentage to drop year on year on a 5-year rolling basis. Now it starts to drop based on the OBR's forecast in 27-28. But as you'll see, it doesn't drop much because it only drops down to 97.3%. So we are still expecting our debts to go up. Our current debt position, I ought to do a little survey to see how many people know what our current debt position is. When I was writing these slides, I merrily wrote down the figure that I thought it was going to be. And I was quite blasé about it because I've written it down a number of times. 2.5 trillion. I don't think it's a figure that we should be blasé about. And when I put it down, I thought, oh yeah, that's what it is. I thought, hang on, step back and think about that. So on that level of debt, we are paying interest. And our interest for the current year is predicted to be just over 120 billion. Now, to put some context on that, I had a quick look on the Office of National Statistics website to see how that compares to what we raise and what else we spend it on. So if we take corporation tax and council tax and add those two together, it's still less than our debt interest. It's also significantly more than what we spend on education. So on education, we spend 77 billion. So our debt interest is quite significant. And if we see any interest rate rises in relation to that debt interest, it becomes even more of a burden. So borrowing and debt is something that they need to focus on to manage. So after all of the bad bits, I thought, is there any good news I could give you? Because it would be quite nice for everyone to actually be a little bit more cheerful rather than thinking it's all bad news. Well, actually, this may not be good news, but it may be supportive news. We're not actually alone. This isn't just a UK problem. There is a worldwide energy crisis, and the rest of the world is actually feeling the same things that we are. So inflation, our inflation rate, the average for the year I mentioned earlier, 9.4%, and it hit 11.1% last month. Europe is fairly similar, all right? So we're not too far out of kilter with the rest of Europe and potentially the rest of the world. Now, during the Chancellor's speech, he actually mentioned that the IMF are predicting that 1/3 of the world's economy will soon be going into recession. Now, I had a quick look at the IMF website just to double check that. And when I was reading through the notes on the main page for the IMF website, it was like reading exactly what was happening to the UK. And they were talking about it from a global perspective. Now, it's not good news, but it was probably comforting to know that we aren't alone with these issues. Now, that last part on the slide was something that the last Chancellor mentioned, in the fact that our debt, now I mentioned earlier, we're looking at debt of 97.6% in comparison to our GDP. Lowest in the G7. I thought that was quite surprising, and I did actually double check that last time because I thought all these things, you never know if we're being told the truth, so I thought I will double check it, and it is right. The lowest is Germany, but the others are all higher debt positions than we are. So although not good news, I think maybe a little bit of comfort can be taken from the fact that we aren't alone. So what did he change? In many ways, a lot of the announcements he made yesterday, none of them were particularly shocking, and there wasn't all that much going on. So from an income tax perspective, the big one that he announced right at the beginning was that the additional rate threshold is going to be cut. So the additional rate threshold at the moment is 150,000, and that's going to drop to 125,140 pounds. I was rather annoyed at the 140 because it makes it quite a mouthful. Why couldn't they have just gone for 125,000? I haven't actually found a reason for it yet, but there must be somewhere. Now, the additional rate is at the point where any income over that level, you pay the additional rate of tax, which on non-dividend income is at 45%. Now, personal allowances and the higher rate thresholds, he announced that these were going to be frozen for a further 2 years. Now, we're quite used now to the freezing of rates and allowances. It wasn't that long ago where they announced that actually these items were going to be frozen for 5 years. They are now going to be frozen for 7 years. So we will see these amounts at the same levels until 2028. Now, in many ways, this feels like he's going to be raising taxes without people noticing it quite so much. And that's exactly what they are trying to do. Because strangely enough, by freezing these allowances, you do ultimately raise quite a significant amount of money over a longer period of time. And the other announcement on the income tax front was that the dividend allowance would be cut. So the dividend allowance at the moment is £2,000 per annum, and that's going to be cut to £1,000 next year and then £500 for the year after. On the national insurance front, again, what he's going to do is he's going to freeze the allowances and the rate bandings until 2028. So again, he's doing the exact same thing as he did with the income tax situation of increasing those period of time that he freezes them for until 2028. Now, I don't know about you, but after everything that's happened over the last 2 months, I thought, I'm not entirely certain where we're actually up to in relation to personal allowances, basic rate bands, what rates of tax do we have? And it was interesting to actually work through what we currently have. So, personal allowances at the moment, £12,570. They're going to be the same until 2028. Higher rate threshold, £50,270. Again, we'll have that until 2028. Additional rate threshold, 150,000 at the moment, then 125,000, and don't forget the £140. Now, our non-dividend income rates, they haven't changed. 20%, 40%, 45%. But notice the one thing there is dividend income. Can we remember that we had the social care levy that was going to be introduced? And so our dividend tax rates were going to go up, and they've gone up for this year. So they're 8.75%. 33.75% and 39.35%. But the one thing that was announced in the mini budget was that the social care levy would be abolished. So in effect, national insurance was going to reduce by 1.25%, but that also had a knock-on effect on the dividend rates. So our dividend rates next year do actually change. Now, who thought we only had about 3 or 4 rates of tax in national insurance? National insurance. Now, national insurance is actually probably one of the most confusing parts for this year because we've had this change from the mini budget. So in relation to our thresholds, as you can see, I've got up there a primary threshold, lower profits limit, and lower profit threshold. Did we realise how many thresholds we actually had in relation to national insurance? Basically, that's saying that for employees, then their threshold where they wouldn't pay any national insurance is £12,570. The employer's threshold is the primary threshold, and that's £9,100. And then we've got a higher rate threshold of £50,270. So national insurance on anything above that rate is at a lower rate. Those are going to be frozen until 2028. Our rates do change during this year. So we have got multiple rates for employees, employers, and the self-employed this year. And when I was doing this chart, I was wondering how on earth I was going to get it all to fit with all these changes. So up until the 5th of November, The national insurance for employees is at 13.25% and 3.25%. That changed following the mini budget. So from the 6th of November, we've got 12% and 2%. For employers, it was 15.05% and that dropped then to 13.8%. The lower ones is what we move forward with next year. Now for the self-employed, you'll see we've got another rate to worry about here in the fact that we have a combined rate for class 4. And our combined rate was 9.73% this year. Now, our IT providers who are actually working out all of these calculations have got a lot of work to do to get all of these rates into the tax returns for this year. The one thing you will also see in there for the class 2 is we've got an increase in class 2 national insurance. National insurance with class 2 used to be quite cheap. They've put it up by 10.1%. Same thing as for voluntary contributions. They have increased them by 10.1%. Some of these things where we're paying them are going to start to feel more expensive when we are seeing those increases. Company taxation. Now, let's just ignore that we had a mini budget, because if we ignore the mini budget, then we'll know where we are with corporation tax. So at the moment, our main rate is 19%, and our corporation tax rate is going to go up to 25%. Now, there was a lot of talk in the mini budget. This was changed to drop to 19%, and then it was reversed. So we just need to ignore that part and go back to what we knew before. We have also got a small profit rate next year, and our small profit rate is going to be 19% on profits below 50,000. For profits between 50,000 and 250,000, we're going to have a marginal rate. Now, I grew up with a marginal rate, so when I heard this was coming back 2 odd years ago, I was like, oh, how exciting, more calculations for us to worry about. One other thing that wasn't announced yesterday by the Chancellor, but was announced in the mini budget 2 months ago, was in relation to capital allowances. So the annual investment allowance was originally due to drop next year to 200,000. They have stopped that, and it's going to be £1 million permanently. That is still in place from the mini budget. So after looking at all of these items, I was actually sat there thinking, okay, well, the Chancellor really had to fill a bit of a black hole of roughly 50 billion. He said at the start that he was going to raise it 50% through his tax policy and 50% through spending policy. Of the announcements that he'd made at this point in time, I wasn't entirely certain that he'd raised enough through tax policy. There weren't enough changes in there. So how was he going to top it up? And this is how he's doing it. This is what we call his windfall tax. So we have seen energy profits levy and an electricity generator levy. Now, the energy profits levy was in place at 25% and is increasing to 35%. And we've got a new electricity generator levy of 45% on what they call extraordinary returns. Now, there is detail in the autumn statement of how these levies and new generator levy works, but they're really confusing, I've got to say, and it's not something that I think many of us are ever going to come across, because this is the big boys. This is where they are making their super profits, and they are going to put these levies in place to tax them on it. If you read through the details, they think that we are going to raise about 15 billion from those two items. So that was 15 billion towards the 25 billion that he needed to raise through his tax policies. So this was actually quite the biggest section of tax raising. Now, I think you've probably heard enough from me already, so I'm going to pass over to Tom.
Thank you, Amanda. I think it's working. Excellent. Good morning, everyone, and good morning, everyone watching at home. For those who don't know me, my name's Tom Chiffers from Clarke Willmott. These events are always give me an opportunity to sort of look back, because I must confess, when I do my slides, I just copy and paste the old ones from last time and then draft over them. But it allowed me to look not only where we were, 6-8 weeks ago, for the mini budget or the fiscal event, but also to look back where we were in the last proper statement, which is in the spring. And as Amanda said, the fears about inflation I don't think we could have dreamed where it actually went to, but it seemed like a simpler time. Everyone was very worried about fuel duty, if I think. Everyone was worried about fuel prices back then. Seemed sort of very innocent in comparison to the issues that we've got. So let's put it into a bit of context. As Amanda said, we had the fiscal event, the mini budget, whatever you want to call it. All of the things that Amanda and I told you last time seem to have been got rid of pretty soon after. I don't think we can take any credit for that. But inflation is at record levels, 11.1%, or depending on what threshold you use, very high. As Amanda said, we're officially in inflation, or officially in recession, or going to be come the end of this quarter. And the Chancellor announced he needed to fill a £50 billion hole. So that was the figure that they released. Lots of leaks and lots of things being put in. It seemed to have a direct line, the Chancellor, to the front page of the Telegraph. Every time I picked up the Telegraph, I looked at it online. They seemed to have another thing that he was going to announce. So it really did remind me, this budget, of the first budget that I think Amanda and I did together, which was the one in spring of 2021. So straight after we were starting to come out of the pandemic, and lots of questions. How are we going to get the tax back? How are we going to pay back all of the things they put in place during the pandemic and during the lockdown? Similar thing this time. We've got a big hole that they need to fill. What are they going to do? The other thing in context was, as Amanda said, the health and social levy was reversed. So I'll come back to that a little bit later. So what did they actually do? Amanda's covered some of the taxes, but I'll carry on and fill the rest of them in for you. So capital gains tax. This was one of the ones that seemed to get the most coverage in the paper, and again reminded me a lot of what happened in 2021. Everyone seemed to be thinking they're going to put the rates up. Lots of commentary saying, yeah, we're in a unequitable position with capital gains tax. It was brought in, I think back in the 60s, to stop people siphoning money off as gains rather than as income. But we've had a strange system since Gordon Brown changed the rates. We've had a strange system where capital gains tax is at a very low rate, whereas income tax, as Amanda said, even higher now, is at a higher rate. So a lot of the commentary saying they're going to put capital gains tax up. It's going to go up to the same rates as income tax, which was exactly actually what they said in 2021. And my fingers were burnt then, and they weren't going to be burnt again. So I was pessimistic. I didn't think they were going to do it, because this budget, just like 2021, has got Rishi Sunak's fingerprints all over it. So they haven't changed the rates. The rates remain unchanged. What they have done is change the allowances. So for capital gains tax, all of us have an annual allowance. The amount of gains that we can accrue in that year without paying any tax at all. So just like Amanda was talking about, thresholds. These are the thresholds where, and anything above that you pay tax, anything below you don't. And they've done something quite extraordinary, actually. They've cut those thresholds. They've cut those annual allowances. I couldn't find another instance in all the times that capital taxes, that's inheritance tax and capital gains tax, has been changed, which is, as Amanda said, a lot. There's been a lot of changes recently, but in the context of all the times those taxes have been in place, I couldn't find another instance of where it's been cut. But it has been cut by more than half. Not now, but in April of next year, so the start of the next tax year, your annual allowance is going down from £12,300 to £6,000. And then the year after that's going to be cut again, cut in half, so it would be less than a quarter of what it is now, right down to £3,000. Now, I'm assuming that the trustee rate, which is currently half the rate that a person gets, is going to be cut in half again, because that's just how it works. They didn't mention any of that I could find, at least, in the budget handouts, but that's my assumption. So that means that if you've got a trust, and you've got lots and lots of investments, and you've got lots of capital gains sitting on those investments, come 2024, you're only going to have £1,500 worth of tax-free gains per year. And if you've got multiple trusts, which some people do, that allowance is going to be split between all of those trusts. So one of my colleagues I was talking to as we were getting a coffee, saying that means basically you don't have an allowance, and I think that's quite accurate. So the rates, as I say, unchanged. They haven't changed at all. So they're still 18% basic rate or 28% for residential property, and then all other gains, it's 10 or 20%. So still quite low in the context of your income tax rates. It's low, but it means that you don't really have that sort of umbrella of allowance, a tax-free allowance. So a lot of the time, whatever the assets have that people have, a lot of the way they're managed is dictated by that annual allowance you'll gain. So it may well be that a portfolio is carrying lots and lots of risk, and then your advisors might be selling enough each year to try and de-risk it up to your allowance. Well, as of 2024, you won't really have very much of an allowance. So it's going to cause some difficult questions. So that's supposedly going to generate, with the dividend rate cut, 1.2 billion a year by 2025. So that 50 billion that he's got, supposedly, this is going to be a little over a 50th of it. So not much. So what does it mean in the wider, just for capital gains tax? What are the increased receipts? Now, in the context of the big taxes, capital gains tax is quite small. So it generates about, estimated to for this tax year, according to the government, 15 billion a year. So that's only equivalent to 1.5% of all receipts. So talking about those big beasts that Amanda was talking about, the profits levy, this is quite small fry. But what it is going to mean is that there's going to be a 3% increase. Come 2028, that 15 billion is going to go up by 3%. So actually, not that much. You know, if you're talking about filling that hole, this is quite a small amount. Now, you've got to put it into context that capital gains tax, as it says on the previous slide, is only payable when people dispose of assets. So what's this going to mean? This is going to mean that people just choose not to dispose of assets. They're going to keep hold of them. One of my previous colleagues, who used to stand where I'm standing and give this presentation to you, Stuart Thorne, he always used to say, no point in putting capital gains tax rates up because it just means people are just going to hold on to their assets. They're not going to do it. So I think that is probably quite true. I think the other thing that probably will happen is people will look to crystallise those gains or make the most of the fact that, rather unusually, we've got the gain isn't coming in, or the reduction, the allowance isn't coming in until next year. So you're probably going to have a 6-month rush, perhaps, where people are trying to make the most of that benign system that we've got at the moment before we get into a much less benign system starting next year. So inheritance tax. So we're talking about a bit of a theme running through this budget, which is thresholds being frozen. So it's tried and tested method for Rishi Sunak, so it doesn't surprise me. He did it in 2021, he's done it again now. They're fixed. So inheritance tax, again, there wasn't much talk beforehand of that going up, but there was talk about exactly what happened. So pretty much what was predicted is what's happened, which is that those thresholds have been fixed. So thresholds were already announced to be fixed until 2026, and that was an announcement in 2021. They're now announced to be fixed until 2028. So put it into context, the nil rate band rate last went up on the 5th of April 2009. So in that time, I have qualified, I've got married. In fact, actually in April 2009, my girlfriend, now my wife, with whom I have 2 children, we haven't even moved in together. So quite a lot has happened in that period of time. So in 19 years will be the time that that nil rate band has been fixed, which is quite extraordinary, really, when you think about the increase in asset values in that 19-year period. Now, I know, slight caveat, he introduced the residence nil rate band allowance in 2015, but 19 years is an awful long time, considering where we are with house prices, for that allowance to be fixed. But just as Amanda was saying, this is a very canny way of increasing tax without actually doing anything at all, because the rest of the economy, the increase in assets, inflation, everything, does the hard yards for you. You don't need to do anything at all. So what are the rates? Just to remind everyone, 40%. So the threshold has been fixed. So not the rates haven't been changed. So the threshold from where you pay no tax, that stayed fixed. The rates are the same, still 40%. Lifetime transfers to trust, those are still 20%. And then if you give 10% to charity, it's still 36%. So those haven't changed. So it's payable on chargeable transfers, death or lifetime. So no difference there. The thresholds, as I say, we should all know these by heart as they've been around for a while. 325,000 for an individual, get a top-up 175,000 in certain circumstances. That's the residence nil rate band. So it means a married couple got £1 million between them. So the rules unchanged. He went out of his way to mention this specifically in the documents to say that all of the rules stay exactly the same, which means all of the thresholds and all of the amounts of which you calculate out all stay the same. So the residence taper relief, the residence taper stays the same. So if you're over 2 million, it still starts to go down. So what is that actually going to mean for all of us? Well, and for how much more tax we're going to pay? Well, if you look at the top box there, not much more. Not going to pay much more until 2028. So only another 35 million is going to be paid then. But that is because they'd already published the extra receipts that they were going to get. Because, as I mentioned just now, they'd already announced they're going to keep it fixed until 2026 anyway. So again, this isn't going to make that much difference. But if you look at how much from previous announcements they were going to get, that's come 2026, nearly £500 million of extra receipts just by doing absolutely nothing at all. So what is this going to mean for all of us? Well, it means that more people are going to become taxable when they die because assets are going to continue to go up in value potentially, or will have gone up in value, so when people die they'll pay tax. It also means that people are probably going to try and come and talk to people like me and try and do something about that because people who would never have considered themselves wealthy are now going to be falling within the tax regime. It also means that trusts are going to pay a lot more tax because one of the things that doesn't get much coverage is that the nil rate band that applies to individuals also applies to trusts. So that is the rate at which trusts pay inheritance tax on every 10-year anniversary or any transfers out of trusts in between those 10 years. So that rate, that nil rate band rate, as I said, will have been fixed for 19 years in that period. Although the stock market goes up and down and house prices go up, and as I'll come to in a minute, might go down this year and next year, assets are still worth an awful lot more than they were before. So a lot more trusts are going to pay tax, so those receipts are going to go up. So in the spring statement, I talked about inheritance tax in the context of house price rises and how the fact that house prices, thanks to forces during the pandemic and the stamp duty land tax holiday, really went through the roof. They really zoomed up. And how unfair it seemed to be that the inheritance tax thresholds were kept unchanged. Well, that's not necessarily the case now. So unlike the mini budget, the fiscal event, we've actually got the Office of Budget Responsibility who can look into this and analyse it. And what they're saying is that actually house price rises are going to fall by 9%. That's quite a big chunk, by 9% between the quarter we're in now and the third quarter of 2024. So one of the things, as Amanda was talking about, we're still in quite a low rate of interest rates compared to how we've been over the last 40 years. But we had a good decade or more of interest rates being absolutely through the floor, absolutely being zero or around that rate. So if you look at that graph, we've had a fairly steady rise in house prices since sort of 2009, 2010 time. And then it really shot up. There's a big rise you can see just before that coloured section during the pandemic and with the stamp duty land tax holiday. So it really went up because in that time, interest rates are still relatively low. I mean, they're still relatively low now, but compared to how they were in the previous decade. But predicted now to fall by nearly 10%. It's important to put into context, even in that worst case scenario, there's two lines on that graph, you might not be able to see it, but even in the worst case scenario, we're still a fair way above where we were at the start of the pandemic. So in the context of overall scheme of things, we've had a big zoom up, we're probably going to have a big zoom down, and then we'll probably, being predicted at least, going to carry on that gentle increase over time. So stamp duty land tax. I spent a long time, most of my slides I think last time were about stamp duty land tax. And it's one of the few things, one of the few survivors of the fiscal event, the mini budget we had last time, that hadn't been instantly thrown in the bin, along with Liz and Kwasi, but no longer. So these were the cuts to the threshold. So just to remind us, they cut unlike the rest of the things, the thresholds were cut. So the zero rate at which you pay no stamp duty land tax have been cut in half from 125 to 250. First-time buyers all the way up to 425,000. So that was announced in the budget as being permanent, but now it has been changed to only being temporary. So one of the sort of overall themes that I saw for the stamp duty land tax cut was actually it was a readjustment. Because of that big house price rise that we've just looked at, the receipts from stamp duty land tax went up enormously. They didn't in the short term because of the holiday, but in the long term, they more than doubled. But now, and so I thought that the cut in the rates was more of an adjustment from the Treasury to say, well, actually, we're getting too much from stamp duty, let's put it back, let's readjust to take account of the increase in house price rises. Well, they've rode against that, they've gone back now. So they said that this cut, the cut in rates, was temporary. It will now be reversed. So we'll go back to where we were pre-22nd of September on the 31st of March. So as we talked about, house price rises might go down, probably will go down, but not for long, and they won't be lower than they were pre-pandemic. So this, again, going through the whole theme of the budget, the statement is that those thresholds are in real terms going to be cut. So just to remind us where we are, that means this is where they'll be until 2025. So non-first-time buyers, zero stamp duty below 250, and then the rest of the rates are as you see them. First-time buyers don't pay any below 425,000, but if you're buying for more than 625,000, you don't get that relief. So what are the receipts? What's it going to mean for the Treasury? So going back to that 50 billion that they need, how much is this going to give them? Well, initially, because obviously this cut is going to stay in place until 2025, it's actually going to cost them money. So this is a negative when he's looking for that 50 billion. It's going to cost him 30 million, and it's going to cost 95 million next year. But after that, it really ramps up. Certainly when we get to 26 and 28, it's 1.5 billion over it's going to generate. So if you look at the context of where we have been over the last years, or at least pre-mini budget, stamp duty land tax generated 17.5 billion for that 12 months. So come 2028, stamp duty land tax is going to go up by 10% if we assume that's the same figure by 2028. So if you put it into context of capital gains tax, that's only going to increase the total receipts by about 3%. But this change, or rather the reversal of the cut, is going to generate an extra 10% for stamp duty land tax receipts. So it's a very significant change over that long period of time. So as Amanda was saying, the approach of Jeremy Hunt and Rishi Sunak has been these long-term freezes to generate long-term returns, and that's very true here for stamp duty land tax. So VAT has been changed. Again, going back to the same old theme. No change is a change. So no increase in the threshold is actually an increase in the tax rate. So for those of you who don't know, VAT is charged on businesses, and if their turnover, and that's crucial, is above 85,000, then they're obliged to register. They've got the option to register if they are under that threshold, but if they're above, they have to register, they're obliged to do so. The current level has been in place since 2017, so it's been fixed at 85,000, but now will remain in place until the 31st of March 2026. So again, we're going to have nearly 9 years of that same threshold. So going back right to what we were talking about, what Amanda was talking about, what I was talking about, inflation where it is, that's going to have a very significant impact on businesses because it's judged on turnover. It's not judged on profits, it's judged on turnover. If you think we're over 11% of inflation, that's inflation on all the goods and services that businesses have. That's going to take a lot more businesses into the VAT world. They're going to be obliged to register. So what is this going to mean for increased tax receipts? Well, nothing for the first 2 years because it's the same as what had already been announced. But come 2025, it's going to generate 300 million all the way up to 400 million come 2028. So is going to have a very significant impact on businesses, but it's also going to have a significant impact on all of us, because who actually pays the VAT? Well, it's paid by the people at the bottom, which is the consumers, the people buying the goods and services from those businesses, because that's 20% that we have to pay an increase. So it's going to have more of a knock-on effect on inflation than the opposite. So as Amanda was saying, the target is 2%, but we're way above that at the moment. This is, I think, going to have a negative impact on inflation, because you're going to have more businesses who are going to be within that VAT threshold. So therefore, they'll be passing the cost on to everyone else, to their customers. So just to finish, we've got the social care cap, which was introduced a year ago, 2021. It's something that had been around for a long time. Way back in July 2011 was when something called the Dilnot Inquiry reported, trying to address the issue of paying for people's care. So this is a very significant issue for people who are in residential care, and they might be there for an awful long time and they're paying an awful lot. It may mean that by the time they leave care or they die, they have exhausted all of their assets. So coalition government, remember that, tried to address this issue with the Dilnot Inquiry, which was looking at what we can do about it, what can happen, how can we stop individuals paying all of their assets towards their care. So what they proposed was a cap on people, the amount that people had to care, which eventually got sort of ignored for a few years, kicked into the long grass. Eventually, something called the Care Act 2014 was published, and that proposed a cap. That was, again, forgotten about. The can was kicked down the road until eventually, last year, that was resurrected, and Boris Johnson announced that they were going to announce a cap, which was going to be at £86,000. That was supposed to be the amount that we all paid. We're not going to pay more than that. Only going to pay £86,000 towards all of our care. A few caveats. It doesn't cover what we call the hotel costs, so your daily living costs, and it only covers what's called your eligible needs, which is, again, a bit complicated. I could spend a whole hour talking about it, but it's not quite as good as it seems. Well, as Amanda announced, the social care levy, which was the announcement that was made at the same time as the social care cap, which was supposed to pay for it all. That was supposed to be the increase in national insurance, the increase in dividend rates was supposed to pay for all of this. That was scrapped, so this was essentially has been dead in the water ever since that, and no surprise then to say that this has been delayed until October 2025. As we've been waiting since 2011 for this to come in, I will not hold my breath that it will be implemented in 2025. I think that's unlikely. So the big problem, the problem that all of us have, and certainly those people in care that have been hoping that it would be dealt with back in 2021 and before, continues to be outstanding, still not been addressed. They've still not grasped the nettle. We've just kicked the can down the road again, and I suspect, not betting man, not predictor, but I suspect it will be quietly buried between now and then, and maybe resurrected by a future government, who knows. So on that happy note, I will finish and hand over to Lexi, who can field some of your questions. Thank you, everyone.
Lovely. Thank you very much, Tom. So yes, do we have any questions for Tom or indeed for Amanda on the various announcements this morning? I'm going to ask one if you guys don't, and mine are mean, so I'd encourage some from the room if you have any. Okay, I'm going to go with mine. So one of the things I thought was missing from the budget was anything around energy support for businesses. Obviously, there was a bit about energy for individuals. Do you have any take? Because I'm conscious that the current support measures end next April, and obviously businesses, huge cost for businesses, energy costs at the moment. Do you have any views on where that might go? Obviously, not being a betting man and open questions, but any thoughts?
Well, you go for it.
There wasn't very much about energy support for businesses in there at all. Do I think they're going to do anything about it? I think they will review the situation as they get closer to the end. So we're due to see changes in support next March. I think they will wait to see how things are going. They're still interested in the prices of fuel at the moment. The way they are working with everything is that as fuel prices come down, which obviously as we're buying our fuel in dollars, as our pound increases against the dollar, they're actually benefiting from it. They need to see how that pans out before they announce anything else. So I think they will wait till next March. We could be wrong, but I think they will wait and see, and then maybe announce something a little bit later next year as to what further support they may give businesses.
Yeah, I agree. I think they're hoping that A, fuel will go down, or B, somehow the pound will go back up and it won't be quite so expensive. But they're going to have to do something because if things stay as they are, you've already got a system where businesses are really struggling to pay the fuel costs as we all are. So I think they're just closing their eyes, hoping that it will sort itself out, or something will need to be done because it just won't be affordable.
No. Perfect. Thank you. Oh, please.
Might be quite a niche question, but relevant from an agricultural perspective. We've obviously heard a lot in news the last few days around elms and what might be coming down the tracks in terms of budgets. Everyone's been waiting for this 17th, we'll be able to tell you more then. Have you managed to unpack anything from a government department perspective that might indicate anything on that side of things?
Me, no.
No, the honest answer is no, I haven't. And I think it's quite worrying that there isn't more information out there about elms because it is such a big deal for farmers and agricultural landowners. So it's, again, you just get the sense that it's sort of being ignored when it should be front and centre because it's such a big deal. So no, I haven't, but hopefully we'll have some clarity soon because it makes such a big difference.
Thank you. Question at the back.
Were there any other announcements on other duties, beer, wine, cigarettes?
Good question there, that was.
Nothing that I came across, actually, no, there wasn't.
I think conspicuous by their absence, I think.
I'd agree.
Somebody mentioned last night about maybe the fuel duty potential increase there.
There's nothing from what he announced yesterday, or nothing that I've seen. The only one was obviously the one that they announced as the Tesla tax, which is going to be on the low emission vehicles, that there was going to be duty on those to bring them in line with normal vehicles, as we'll call them. But there wasn't, no, it was absent.
Yeah. Usually it's the nice banker they can think this is going up, this is staying the same, but no, nothing at all.
Did you say that the electricity generating levy had a threshold?
I've got to admit, I don't know much about it. It's not something I've ever come across, and as I was reading the notes, it gave some information, so I don't know the technicalities of how it's calculated.
Question at the back.
Can I just be mild to a bit, but we do like interest rates being announced shortly for April next year, so I don't know whether you can influence on that.
Not an awful lot, no. Again, there were many things that weren't actually around, and I will say I haven't. I still haven't read everything that was out yesterday, but I haven't come across an awful lot at the moment. So there were things that were slightly conspicuous by their absence. But the one thing to remember is obviously we do have another budget predicted for next March. So they could be saving a lot of these things actually for something else to happen next March. They may be holding back just to see how things settle down over that period of time before we hear very much more.
One question I had, if I may then, because obviously there's been quite a lot of changes in allowances, rates, dividend rates, capital gains tax allowances. If you were going to give like a very easy, what would you do if you've got discretion over the timing of your income, the timing of your capital gains? What would be the easy kind of quick wins from a tax planning perspective, I guess, to take away from today?
Yeah, you go for it.
There is no quick win. After everything we've seen, you've just got to hope that actually now the aims that we've got there of stability do stand fast. Now, I think from anyone who's got dividends, the one thing you saw there is that actually our dividend rate is going to be slightly lower next year, so it's worth holding off a little bit for dividend planning for next year. Strangely, I was talking to a lot of my high earners a number of days ago going, oh, you probably want to get your dividends in early because I think the tax rates might go up, and we've had those discussions over the last week of what might happen. But it does look now that we do have a slight fall in the dividend rate for next year. So for dividend planning, I would suggest that you might want to wait. Capital gains tax, start getting your transactions in.
All I would say is that if you look not just between now and next April, but if you're looking at now and the April after that, you've got less than a quarter of the annual allowance. So that's a big drop. If you've got a really significant capital gain, the gains in the hundreds of thousands, it's not going to make much difference. It's going to cost you a bit more tax. But for those people who their gain is around that current allowance, or if you're a married couple and it's around double that, then going down to less than a quarter in 2 years' time or 18 months' time is going to have a big impact on people. So all I would say is that if you do have things, if you've got things, an investment property or stocks and shares that you think you might encash one day, maybe it's time to think about doing that between now and April, because otherwise it's going to cost you a fair amount.
Perfect. Well, if there's no further questions from the room, I don't think there is, then I'm sure you'll all join me in just extending our thanks to Tom and Amanda, particularly for working on this so late last night to get it all ready for this morning, and your advice. So thank you guys very much. And I think just one last thing for me on a slightly lighter note, I think having possibly depressed you all with tax and recessions and things, we are hosting an event for the Football World Cup on Monday, so there's some flyers on your table. So in case we've depressed you too much today, do feel free to come along and join us for a beer and some light relief for that on Monday. But thank you all very much for joining us this morning.